And good morning, everyone. Thanks for joining us this morning for the press briefing for the autumn 2022 commentary. Usual format again. I'm going to talk through a range of indicators, and Kieran is going to step in halfway through, and then we're happy to take any questions that you have. At the outset, I just want to say a big thanks again to the team here for all the work gone into the commentary. There's a huge amount of work goes in every quarter to produce the document, and a particular thanks to Wendy, Owen, to Eva for all the work and inputs this time round, and as well to the contributors from the broader ESRI, particularly Mira Lynch, for contributing analysis in this particular commentary. So thanks again to everybody for their inputs. Okay, so we're coming to you again in a position a bit like we were in the summer, with really high levels of uncertainty and a very fast-paced changing context for the Irish economy. There are very large and growing international concerns and challenges that emerging on the international horizon, which are all clouding the outlook significantly. However, despite that, we say this quite often, the Irish economy is expected to register positive growth in both 2022 and for next year. And in particular, we've actually revised upwards our growth projection, particularly for domestic demand for this year. And that's on the back of very strong capital investment towards the early part of the year, which are driving forward the domestic demand activities. However, we do expect some of that to fade, and I'll talk through that in a moment. So in general, when we look across the broad range of factors that are contributing to the outlook for this year and into next year, there are a range of kind of conflicting factors. For example, on the domestic side, the savings ratios for Irish households still remain very high in an international context, and also in a historical Irish context. We're looking at savings levels just below 20% at present for households, and that's nearly double what it's been historically in Ireland. And that really is contributing towards considerable resources available for households to be able to make consumption expenditure decisions, and winding down that towards more normalized levels, which we would expect certainly in the medium term. It provides a context for inflation, or for consumption growth, which is likely to provide an upward stimulus to consumption, taking into account all of the other factors. So that's certainly a context-specific factor for the Irish economy. In terms of the labour market, we've seen a very fast recovery in the labour market, with the unemployment rate really dropping down from the COVID levels to very low levels of unemployment. In a sense, we're operating at full capacity in the Irish economy at present in the labour market. We're looking at full employment, and Kieran will talk through that a little bit more in more detail. A feature that we've documented for many quarterlies now, and in research that we've done, is the very rapid growth of exports, which really have been driving the GDP figures for many years, and that is continuing into this year. We're expecting double-digit growth in exports, and that's mainly due to the very strong sectoral composition of the export activity, particularly in the ICT and pharmaceuticals area, which we'll document. And to date, one of the things we've seen is that despite the international global slowdown, this export activity appears to be uncorrelated with these global conditions more broadly. They seem to have very sector-specific growth rates, and that is feeding through. So despite the international downturn, we are still seeing growth in exports in these particular areas. So that's a feature to note. And as I mentioned earlier, export growth or investment growth was very strong at the start of the year. And that's even the modified investment. So if you just quickly look at the table, you can see we're expecting strong growth in GDP this year, and growth in GDP next year. But also when you look at modified domestic demand, which focuses on household spending, net government spending, and investment, excluding the aircraft, the leasing, and the RD-related intangibles, we do see strong domestic demand even this year, and we're expecting growth next year, even though that is moderating downwards quite considerably from our previous forecast. And again, I think many of the risks are on the downside, in particular in the modified domestic demand. So to just kind of highlight those risks from the outset, normally we talk about these later on in the presentation, but just to highlight these factors which really are creating a very heightened degree of uncertainty around any of the forecasts we do. And it's an extremely difficult time to be very certain about the trajectory of many of the aggregates we're talking about. But when we look at the various inflationary factors that we're seeing hit the domestic economy and the international economy, you look at the impacts on the energy markets from the Ukraine effects, the other ongoing supply chain bottlenecks from China and other places which really have disrupted international trading activity since the pandemic period. These are all ongoing, and all of these are pulling down the broader international outlook. In terms of our main trading partners, for example, the EU, the UK, and the US, all of these economies are forecast to experience slowdowns and in many cases recessions. And these effects are likely to pass through into the Irish economy, even if we may not see them in some of the aggregates like the exports because of the sectoral concentrations. These are likely to affect Irish companies on the ground in terms of their trading outlook. Naturally, with the higher inflation rates that we've been observing, the monetary policy authorities across many of the major economies have been tightening policy rates in response to that, with the aim of trying to reintroduce price stability in the medium term. And naturally, these higher rates have costs for the economy. They make credit more expensive, they make servicing debt more expensive, and this is naturally going to pull down investment activity, consumption activity, and will have impacts on other market segments like the housing sector, which Kieran will talk about later on. So in general, while we have moderated down our outlook for domestic demand for next year, I think many of these factors are all working on the downside. So all of these risks are likely to be on the downside in terms of the international picture and the international outlook. And with the commentary, we present a Nowcast, which basically takes into account all of the very timely indicators that we have, that feed into our assessment more generally, and we model what we expect our outcome to be for the current quarter that we're in at present. And you can see when you look at the actual data on the model fit for the modified domestic demand Nowcast, we can see this downward trajectory starting to come in the Irish economy for the domestic sector. So you can see the Q3 2022 Nowcast, which is in green there, is a step lower from what we've seen with the actual data for modified domestic demand for the early part of the year. So the downward trend in the economic outlook is certainly feeding through into the data that we're having from our Nowcast model. So that's mean we're building that into our overall assessment of the growth trajectory for this year. So let me talk a little bit about consumption. So we've revised down our consumption forecasts for this year and our outlook for next year. And I guess there's two countervailing effects here. So naturally, we've got the very elevated levels of inflation, and that is moderating real incomes. So households, expenditure patterns are adjusting to the drop in real incomes. However, the savings ratio still remains so elevated on a historical context that households do have that expenditure buffer, especially higher income households. And this is likely to be able to provide an offsetting catalyst against the rising inflation rates. Naturally, when we think of the average savings ratio, there is a big distributional effect. So households at the bottom end of the income distribution are likely to not be able to accumulate savings to the same degree as higher income households, and that is necessarily affects the path of consumption, and because higher income households save more of per unit income, so therefore the consumption effects are not as big. But we still would expect the savings ratio to come down in the years ahead, and that will provide some sort of buffer to counteract some of the inflationary effects. But that will only go so far. So forecast for this year is just over 3%, and for next year for 2.5%. So that is a downward revision on our summer commentary. I think one of the effects you can see very clearly since the war in Ukraine is a very notable drop in consumer confidence. You can see the chart here presented looks at Ireland and the EU, and you can see very clearly from the early part of the year there's been a very, very drastic drop in consumer confidence as these inflationary pressures have hit, as real incomes have been hit, households are seeing their spending having to pull back, and that their euros are not going as far as they used to, and that is all feeding into a moderation in the household expenditure growth. We've seen some of the more data-based indicators such as retail sales. These have been coming down in real terms in the last number of months, which is really a good leading indicator for the path of consumption going forward. Let me talk a little bit about investment. It's obviously one of the more volatile components that goes into to our assessment, but we are seeing very strong growth this year, in particular in the modified domestic demand, which normally the overall investment level is the one that we associate with major swings because of the aircraft leasing or some of the IP activity. But the modified investment itself is rising very rapidly this year, and particularly the first part of the year. So that's why we've actually increased quite notably our investment outlook for this year. Now, that is likely to be driven by multinational activity still, even though it is in the modified side, because multinationals commit capital all across the economy in a range of different activities. So, it is still an FDI effect that's feeding through here, but it is growing quite rapidly this year in particular. For next year, in line with the broader moderation in the outlook and the deteriorating international picture, we are revising downwards our modified investment forecast for next year. And in a sense, we're moderating growth across the investment activity across different asset classes. It's all coming down in line with the moderation. Firms are more uncertain about the outlook, therefore the commitment to capital will be lower in that context. I will say that it is very extremely difficult to forecast investment given the sectoral concentration of the FDI, but in general we are expecting some of that international deterioration in conditions to feed through in the investment activity. I think it's clear when you look at these charts, which look at business sentiment from the European Commission sentiment index, and you look across the different sectors. So we have industry, services, retail, construction here. Across all of the sectors, we're seeing a deterioration from the early part of the year in terms of the outlook. This chart here looks at just general business confidence, and it's deteriorating. It's highly unlikely that this wouldn't pass through to the investment outlook for Irish enterprises. Yeah, in terms of export activity, it's very clear that we have this high sectoral concentration of our export portfolio in these two very well-performing sectors, ICT and pharmaceuticals. They're increasing year on year, and they're really driving the double-digit growth we've been seeing over the past many years in exports. And in a sense, we are expecting that to continue, given that we've seen it for the first 2 quarters of this year. So we are bidding that into our expectation for this year about strong trade activity and strong export growth, which is really linked to these sectors, which don't appear to have a high correlation with the movements of the international events. And in a sense, they are acting kind of as an insulation policy, but that concentration does have huge risks in the broader context. To just look at specifically at our forecasts, we're looking at double-digit growth in exports this year, but there will be an increase in imports activity as well. And for next year, we are bidding down our export forecast, linking the trajectory with the broader deterioration in the international conditions and the heightened uncertainty that's happening on an international basis. So still it still will be notable growth. I think one chart we wanted to highlight this time round was just how important these two particular sectors, this is the ICT sector and the the industrial sector, which includes the pharmaceutical sector, are becoming for the Irish economy. This chart here shows their percentage of overall GVA. And you can see since 2015, these two sectors have really been growing enormously in terms of their contribution to the overall Irish economy. So these really are hugely important when we're talking about the broader trends and mapping through the export activity. And really, that's one of the reasons why, despite the very serious deterioration in some of the international economies, we still are showing quite a notable path of growth for the export sector. And it's because these sectors appear to be insulated against some of those international movements. They have very sector specific patterns. So we just thought it'd be useful to highlight that. So thanks very much, everyone, for your time. I'm going to hand over to Kieran at this point to talk about the labour market, public finances, and the general assessment. Thank you.
So what we've done then, because of the, I suppose the huge nature of the corporation tax receipts, we've actually devoted a box. Our colleague Owen Kenny has written a box in terms of looking at this issue of the sustainability of the corporation tax receipts, because it obviously is a hugely important issue as far as the sustainability of fiscal policy is concerned. In particular, what Owen has done is looked at the potential sensitivity of corporation tax receipts to the OECD GLOBE rules, which are being considered at present. And obviously, as part of that, there are two different pillars. Pillar one seeks to attribute more of the taxable income to the jurisdiction where the sale has been made. And, there's obviously been concerns from an Irish perspective that we may lose out in terms of receipts, because obviously, there's a significant amount of the receipts come from other jurisdictions as opposed to where maybe the country, the company concerned is headquartered. And the second pillar introduces the concept of a global minimum effective tax rate, an ETR of 15%, which of course is higher than the taxation rate that we've had as far as corporation tax policy is concerned. Now, what Owen does is it takes a variety of different scenarios, and obviously, the overall results are very much conditional on the scenarios assumed, both for pillar one and pillar two. He takes, what are fairly plausible, I think, scenarios. And overall, I think the conclusion is that we think these results or the OECD proposals will leave corporation tax receipts relatively unaffected, I think, in the forthcoming years. So we don't see a sizable impact as far as these measures are concerned. Now, obviously, it depends on the nature of the scenarios. You do have, I suppose, the downside risk is the potential relocation of some of the multinationals that are exposed to these changes. These could relocate from the Irish jurisdiction to elsewhere, which would have a significant impact on the exchequer. However, given the fact that a lot of these measures are global in nature, it's a little bit difficult to envisage that might be the case, that you'll have a very substantial relocation. But nonetheless, there is that downside risk. The upside risk, of course, is that you could, and a number of people have commented on this, concerns the whole issue of capital allowances. So obviously, multinationals have been using the capital allowances, if you like, writing them off against their taxable profits. And that's been reducing, obviously, the amount that can be taxed. However, a lot of those capital allowances are tied to kind of 8-year terms. And I think there is certainly some anecdotal evidence to suggest that those 8-year terms are coming to an end, which may result in the taxable profits actually increasing. And that could be behind some of the surge that we've observed in the last year or two. But again, without access, I suppose, to the granular data, it's hard to make that distinction and hard to make that definitive assessment. In terms of inflation, then, clearly what we see as far as inflationary pressures are concerned, we see inflation running at over 8% in the most recently available data. Our expectation is that this year we're revising upwards slightly our inflation estimate up to 8.1%. We are expecting higher inflation next year of 6.8%. That reflects kind of base effects from this year, but also reflects the fact that the Irish economy, given in particular the relatively low rate of unemployment, that in itself could generate certain inflationary pressures within the economy. So, we do see heightened inflationary pressures into next year. As has been noted elsewhere, clearly if you look and delve into the inflationary figures, it's clear that the inflation rate faced by different deciles of the population varies. with those at the lower end of the income spectrum, and particularly those in rural areas, witnessing higher rates of inflation. It's also intuitive or informative to look at comparing Irish inflation rates with other countries across both the euro area in terms of different categories. So Conor, if you move it on there to look at food and non-alcoholic beverages, and then comparing Ireland's inflation rate there at 8.8% with, for instance, the rates in Germany of 15.7%, the euro area on average of 12.5%. And then comparing that with how we fare in areas such as electricity, gas, and other fuels, where you've seen a sizable increase in inflationary pressures there. As far as the Irish market is concerned, it's dipped a little bit in recent months. That's, I think, mainly due to liquid fuels have decreased somewhat since June, and I think the growth rates for gas and electricity have peaked in June as well. One other box that we look at in the commentary is the housing market, and obviously there's been a lot of commentary about the housing market, and indeed we look, for instance, in the last commentary at the effects of the potential effects of the increase in the policy rate at the euro area in terms of its impact on the housing market here. We followed that analysis up with just a general assessment of where we see the market right now. And like a lot of housing markets, the Irish market saw a surge in house prices in the last year and a half, 2 years. Some of that, we believe, is attributable to the increase in savings which accrued after the pandemic. So, there was a sizable, as Conor outlined in terms of discussing consumption, sizable increase in the savings levels, savings rate. And we feel that some of that has certainly filtered through into the housing market. If we do our customary analysis that we do on the market, what it suggests is that the market is presently overvalued by approximately 7%. Now, that analysis applies right up to the end of 2021. Obviously, as we move into 2022, we've seen continued increase in house prices running up to 15% year on year in terms of the annual growth rate. So it's likely that overvaluation has possibly increased somewhat in the recent quarters. Now, that doesn't necessarily mean that house prices are going to fall by that amount. But what it does suggest is that really the kind of substantial increases in house prices that we've witnessed cannot continue into the future, and you're likely to see a significant moderation in terms of house price growth in the coming quarters and over the next year. Whether we see falls in house prices is probably too early yet to make that assessment, but certainly the market is likely to cool. And of course, that cooling process is aided, if you like, and abetted by the kind of likely future increase in policy rates that have been signaled at the ECB, and therefore then the follow on through, if you like, into the domestic market in terms of higher mortgage rates. So both of those things are likely to see a significant cooling off, I think, in the housing market over the next period of time. Therefore, then, just to conclude with our overall assessment, obviously, the inflationary pressures have been exacerbated by the energy-related issues. We'd like to signal as well that the box by our colleague Muireann Lynch and Wendy Dish, which looks at the issue of energy security in Ireland over the next period of time. We think that's a very notable contribution. We see the inflationary pressures generally in the economy have become more broadly based. And now we expect inflation at over 8% this year and around 6.8% in 2023. The surge in taxation receipts over the last year or two has enabled the government to assist those who are most affected by increases in the cost of living. However, we would say that those policies need, again, to be as targeted as possible to ensure that they don't in themselves have inflationary consequences, because, as we say, we do see, a continued buildup of inflationary pressures in the domestic economy, mainly because of the strength of the underlying labour market. Despite downward revisions of global output, we still see the economy growing this year and next year, albeit the rate of growth moderates quite significantly next year in terms of both GDP and in terms of modified domestic demand. So therefore, we see modified domestic demand increasing by 4.5% this year and by 2.5% next year.